So I started sharing my story of how I kind of figured stuff out on my own. I didn't have this like financial education that was passed down from a previous generation. And I spent a lot of money and I didn't know how I was spending my money and how it was going so quickly. And it was really because I was using myself as an emotional crutch in a sense. And that's how I dealt with everything, by shopping. And I had to figure out how to get past that, and from a mental barrier perspective, how to push through that. And I did. It took a while and it took time, but I was able to pay off a lot of credit card debt, and I started investing. Luckily, I started investing even way before I knew anything about investing, which I think happens with a lot of people. But of course, the more you know, the better. That's why I love teaching these workshops, and that's why I started teaching, because I said, I wish I would have had a simple class to break it down very easily so that I can get started in a simple way without knowing too much, but at least having a good sense of what I do and how much I can build off of there. And that's what I did. And so it's been really an honor to be able to teach so many students how to get started with investing. And a lot of them are from my community. I was born in DR, and sometimes things are unusual for us, and oftentimes we come from backgrounds where we're not taught these things, and that's why I'm here to teach you today. So we're going to cover a handful of things. We're going to cover some money basics like budgeting. We're going to talk a little bit about credit cards and debt and how to manage that. I'm going to leave a portion for the end of the class for Q&A, so you can basically ask me any question that you want regarding money and credit cards. But then a big part of this class is definitely going to be about investing, because investing is so key. And I want you to know right from the beginning that you don't need a lot of money to get started. It's just always about being consistent and building a good habit and having a good idea of at least where you're headed. We might not know exactly where we're going to end up in life, but we kind of have an idea of what we are comfortable with and what we would like to do. And that's how you want to think about investing as well. All right. So let me share my screen now. People are coming in, and if you're coming in, join us. I would love to know in the chat, like where y'all live. I live in the Bronx. I would love to know where everyone is from, or if you weren't born here like me, where you were born. And if you're already investing, or maybe your goal for 2022 is to pay off debt or to improve your credit. Let me know where you're living, where you're from, and what your goal for this year is. Would love to see that in the chat. So I'm going to present my screen, but definitely feel free to drop questions in the chat as we go. Like when you think of a question, drop it in this chat. And at the end, I'm going to go into the chat and answer those questions. So you don't have to wait to the end to ask the question. You can just drop them in the chat and I'll get back to them. But if you want to ask them in person, you can definitely wait towards the end. So I'm going to share this and present it now. Okay, there we go. Okay, Alyssa, do you see that full screen?
I think it's loading to a full screen. I see it.
It's there?
Yeah.
Okay, perfect. So welcome to the investing workshop. This is an intro to money management and investing. My name is jully-alma, as I mentioned, and this is just a little bit of what I do and where I've spoken and where I've taught. I write, I produce videos online. You guys can check me out on YouTube, and I also have talks that are also available on YouTube. You can also check those out. If you want to get this full presentation without having to worry about taking too many notes or things like that, you can send me a text message at this number, 917-636-4049, and I will send you the link to this full presentation right afterwards. So when we get off, I will go to my text messages and send you the link if you text me the word wealth. So you can go ahead and do that. I'll share this number towards the end as well. You can also follow me on LinkedIn. You can find me jully-alma right on LinkedIn, and this is what my profile looks like, so that you know it's me, because we got to be careful these days. There's a lot of fake profiles and accounts out there, so be very, very cautious. to make sure that you're following the right people. And this is what we're going to cover: the stock market. We're going to cover types of accounts that you're going to use. We're going to cover some strategies. We're going to specifically focus on index funds and ETFs. We're going to talk a little bit about Bitcoin and crypto because it's so interesting and it's so new. We're also going to talk a little bit about taxes. Don't be afraid. Don't worry. It'll be simple. And we're investing while in debt is going to be a big one as well. And then some alternative investments. So the very basics of money management, we really want to get a sense of taking charge of our financial lives. And how exactly do we do that? Well, one of the most important things that I always tell people when they're truly starting from scratch is knowing your survival number. And a survival number basically is the number and the dollar amount that you need to survive on a month-to-month basis. And I like to calculate it on a monthly basis. And then I also like to do the yearly calculation for it. And the way that you figure out what your survival number is really about 7 categories. So the first one is kind of rent and utilities. The next one is going to be groceries. Dining out is also a must because we all do that. We don't eat at home every single time. You also want to include healthcare costs, and personal care. You also want to include some entertainment because, of course, aside from working and doing all the things that we do, we also want to have a moment of rest and entertainment. So those categories that you include in there, stick to it as the bare minimum, like truly what you need by paying rent, exactly how much food you need. And figuring out your survival number isn't something that you do kind of right away. It's something that it takes a little bit of time, maybe like 2 to 3 months to figure out exactly what it is. So you can kind of test it and see what it is that makes sense. But the best way for you to really start looking or developing one is to look at what you spent last month. So if you look at what you spent last month, and it could give you an idea of how much you spent. So last month was December. It's an anomaly. December is the month that everyone always spends more than usual. But if you go back a couple months, you can kind of reference it and look back and see how much you've spent and also what you would like to actually spend. It's truly about creating some sort of baseline, some sort of budget so that you know this is what I need to survive. Everything that I spent outside of this particular survival number is things that I'm spending because they're extra. A little bit of extra shopping, a little bit of extra dining out, extra entertainment, going to the movies more than a couple of times a month, those kind of things. And really what this helps you do is it helps you kind of analyze what your habits are. And it also shows you where you prefer to spend the most money. It also shows you where you might not like to spend a lot of money, but you do. And a really great example of that, especially if you live in like New York or maybe even in the tri-state area, it might mean that you may not have a car and you spend a lot of money on like Uber rides, right? So that's an example of something that you don't want to really spend money on, but sometimes you're put in the situation where you do. So analyzing these habits and figuring out what is it that I actually spend on that I am okay spending on? What is it that I spend on that I am not okay spending on that I want to improve? And then also figuring out based on that, what is it that I'm going to do going forward? And once you kind of lay out those 2 very important points of figuring out what your survival number is and figuring out what your habits look like, you start by writing down your goals. And you want to write goals for the year. And you also want to write your goal for your life. And that's what we can oftentimes call our dreams, right? What are the things that we truly want out of life? What the things that are going to make us really happy, right? And sometimes that has nothing to do with money, but many times it does. It means being able to buy a home. It means having transportation, buying a car, those kind of things, or providing for people in your family. Those are the kind of things that we list on. This would be amazing if I could do and take care of the people that I love the most. Or it could be things like I want to be able to travel and I want to visit Paris, right? All of those things you want to make sure that you write down. So having a list of goals, like very specific financial goals, It could be like saving a certain amount of money and then having a list of dreams, things that might not be as specific, but you would really love. That it's really great to classify them in two categories. So you can work on your immediate goals, but then also use those immediate goals to work towards the big dreams. I love to say that one small financial win a day is going to be a really important recipe for success with your financial journey. And that might mean literally, oh, I didn't buy breakfast today, or I saved on by canceling a membership that I wasn't using, or I avoided ordering out that day, or I called my credit card company and was able to reduce the interest rate on this credit card. Those are the kind of things that give you a small win and really encourage you to kind of keep going as you prepare for these bigger wins from a financial perspective. And of course, the last part of this financial toolkit, when it comes to the basics of figuring out what you want to do with your finances, is to invest and always keep investing no matter how the market is doing. I'm going to pause for a second because I want to make sure that there are no people waiting in the waiting room. And I think there are. So let me see, admit all. Okay. Because I didn't get a audio alert. So hopefully that should be okay. And I'm going to see if I could also make Alyssa co-host. All right. All right, we might be okay. Well, welcome to everybody that just joined in. We were talking about that financial toolkit. If you weren't here, if you missed some of it, don't worry at all. You'll have the recording. I do ask that everybody just mute themselves when they enter the room. So be aware of that. Make sure that you're muted, all right? Okay, let's continue. So. Okay, I think I could just go back and forth like this. So when we're thinking about that survival number, you definitely want to figure out what's going to be the best strategy for you to organize your budget. And it could be very different for different people. I personally use this one on the right, where I figure out what my survival number is for the month in my situation. And in this particular example that you see here, it's 3,000, which equals to 36,000 for the year. So I need to make at least that amount of money to be able to survive, right? That's why I love calculating the survival number. And you can kind of see the details in here. I'm going to share this link at the end of the presentation, so don't worry about that. It's a spreadsheet that I created that you can access. You could just make a copy of it and figure out your own personal survival number. Then on the left, you see something like an app. So there are apps like You Need a Budget, also known as YNAB, and there's apps called, like one that's called Every Dollar. So these are both free apps that you can use, and you can really start to monitor your budget. You can really start to see what your patterns are. As I mentioned, analyzing your habits and your patterns really helps you kind of determine or figure out who you really are and how you spend money, and if you want to change, because you can of course keep doing the same thing over and over, but of course it's going to lead to the same exact results. If you want to make a change, if you want different results, you definitely have to make a change in your everyday lifestyle. And so pick the method that works best for you. Some people like writing it down, keeping track. I do, and I do it electronically on Google Sheets. That's the one that I'll send you. But you can also use some of these apps, give them a try and see them. So when it comes to credit is probably the reason why I started investing Latina, because when I got my first credit card, my story is really funny because my first credit card I got when I was 12 years old, because my dad worked in the Bronx and we lived in Brooklyn, and he said, okay, he had gotten his first credit card. I was 12 years old, so he was well into his adult life. He was in his 30s when he got his first credit card. He said, I got this credit card and I'm going to give you one as well so that you can use it in case of emergencies. So I was like, okay, I'll use it in case of an emergency. Sounds good. But what happened later on, I didn't really use my dad's credit card. And I was so in the habit of having credit cards and having access to credit that when I really went out into the wild as a teenager, I started using those credit cards, and I ultimately ended up abusing those credit cards. I started spending way more than I had coming into my bank account. And it was a struggle. And I ended up thousands and tens of thousands of dollars in debt. And I didn't have enough resources, enough money coming in to cover it. And I had to do something. And that's something that I did was I literally cut those credit cards up. And I said, if I do not have cash for this, I am not buying it. And I did that for a while, and I had to re-figure out my habits and stop spending and the things that I really was addicted to spending, which was for me, for everyone it's different. For me, it was clothes and shoes. And eventually it took me about 2.5 years, a little under 2.5 years to pay off my credit cards, but I did because I focused on it. But let's talk a little bit about credit. The most important thing that you have to know about credit is how we're graded. So having a credit score is like having a report card, right? It's like having a teacher constantly checking over you. And it is an important number, but I also want people to understand, and I wish I also kind of understood this earlier on in life, is that it's not the end all be all. It's not the thing that determines if you're good or bad at life. Okay. And actually, it's not the end all be all of money. There are tons of people that actually don't even have credit cards, that don't use credit cards at all, that just use cash, and they're totally fine with that. But as you all know, establishing credit in this country is an important part of being able to take out loans, get access to credit, build a business. All those things are depend on having good credit history. So it's important that we build our credit history. And this is what's most important. As soon as you open up a credit card, if you happen to not have one, your first credit card, make sure that it is a credit card that does not charge an annual fee, because you're going to want to hold on to that card for a long time. So your credit history, I'm going to jump a little bit. We're going to go back to what the other ones are, but this 15% here is your credit history. And the longer that you have a credit card, the better your score is going to be. So that first card or your oldest card, if you already have some credit cards, you want to hold on to that one, and hopefully it has no fees. And if it does, try to get rid of it and have the next oldest card be your oldest card. But you definitely want to hold on to it because it really tells a lot about how you manage credit and how you've been able to keep a specific card open for a long time. So people, when it comes to the credit score, that's a good thing. But the most important part of any credit score is payment history. As long as you're making payments on the credit card, honestly, credit cards companies, they don't care that you pay it off. Although me as a personal finance person will tell you, please pay off all of your credit cards because it becomes too expensive to pay interest to those cards. But they don't care so much that you're paying it off, because if you're not paying it off, they're making money off of you. So as long as you're making minimum payments, you're going to have a high score. So some people that have a lot of credit card debt will still have high scores because they make their payments. And then the second part of the score is how much you owe. 30% of your score is based on how much you owe as a percentage of what your available credit line is. So if you have $5,000 of debt and your credit line is $10,000, that's 50% usage. That's high. You want to be below 20% usage. So $2,000 out of a $10,000 credit line is really the max that you want to do to make sure that your credit score remains at a nice level, and credit history, as I mentioned, is 15%. The type of credit that you use makes up 10%, so not a big part of it. But if you have multiple types of credit, it affects you 10%. So that means if you have a mortgage, if you have a car payment, if you have credit cards, these are all different types of credit. Some are revolving, which means like a credit card. Student loans they have an end period. So that means that once it's paid off, it's done and it's off of your report. If you have a mix, it tends to allow you to have a higher credit score, but it's also 10%. So it's not a big deal, which means don't go out there getting a loan just so that you can have a different type of credit in your credit accounts. And then the last percentage, 10%, is inquiries. So anytime that you apply to a credit card, you can expect that your credit score will drop 10, 15, sometimes 20 points. So be very cautious to only apply for credit very strategically. My rule of thumb is to only apply for credit once a year, a new card only if you need it. And I like to also recommend to not have any more than 5 cards. Stick to the biggest banks that are out there. Don't try not to have store cards because they charge very, very high interest. And not only that, but they don't really treat their customers well because they are very quick to close your account without you even knowing it. So it's best to the bigger banks, Citibank, Chase, Capital One, and they'll be able to, and you'll be American Express, and you'll be able to have those accounts for a long time. So we talked about kind of like a little bit of budgeting and a little bit of credit cards. Now I want to go ahead and jump into investing. I want to let you know that the word investing is a very big word and it means a lot of different things, but everything can be classified in 3 main categories. So you can invest into the stock market, you can invest into real estate, you can invest into business. Anything that you can think of when it comes to investing basically falls under these 3 categories. And some examples and strategies under the stock market include target date fund investing, index fund and ETF investing, dividend investing, options trading. So, and there are a handful of other ones, but these are the biggest ones and the most popular ones. When it comes to real estate, you can buy and rent property, you can fix and flip property. You can also wholesale properties, which just means that you're kind of like the middle person. You're never owning property, you're just finding properties and selling it to somebody that has the money to buy them, and you're making a profit in between. And you can also syndicate, which means when you see a lot of sky rises, or whenever you see a sky rise, not one person has bought that sky rise. A lot of people come together, they pool their money together, and they pool their funds to be able to build that sky rise, and that's called syndication. Then when it comes to business, there are things like small business lending. So you can lend money to a local business in your community and charge 5%, 10% interest, and they'll pay you as they make money. You can create a product like candles, you can create gift bags or baskets, you can create any sort of product. You can also provide a service. Kind of what I do, I teach people how to invest. So I provide a service and my time to be able to give them something of value, or you could even build technology. And there are, of course, many other businesses. I actually have a bunch of businesses listed later on in this presentation. But remember that investing really only falls under these categories. And if you want to get started about how you want to, or start thinking or deciding how you want to start investing, you basically want to choose one of these categories or a little bit of each of them. Okay, so the simplest one is going to be the stock market, and I'm using the word simple because even though a lot of people are very intimidated by it, it's actually one of the lowest impact ways. Like, it requires the least amount of money to get into. As you can imagine, to invest into real estate, you need a significant amount of money, and to invest into business can also require quite a bit of money at the beginning. So why do people invest? The reason people invest is because the value of securities, assets, and real estate will always be greater than cash. So cash, the value of cash devalues every single year. Inflation causes a sort of shift every single year in our economic system, where what you bought for $1 last year, now this year is going to cost $1.25. So as the value of the dollar goes down, it's important to try our best to retain value by placing it into things, whether it be appreciating assets, real estate, the stock market, something that's going to give you a return. So that's why people invest, because they know that inflation will erode their cash value and investing will increase their cash value. And a big question that I oftentimes get is, how come the stock market goes up? How does it continuously go up? And it's for two very important reasons. There's always a lot of productivity and there is always a lot of innovation. It's either one or the other. If you look at any company within the stock market, they have either innovated and created something that has never been done before, or if they've been around a very long time, they are productive and they continuously figure out how to become more and more productive. So they basically make things cheaper, they make things faster, all the things that are going to allow them to increase their profit and decrease their expenses. So when we start thinking about how we actually start investing, right? That's the big question. Okay, I want to invest into the stock market. I like that the value continues to go up, but how do I actually do it? So there are three ways. A lot of things that we think about when it comes to money is into three. So we have three categories of investing. There's three options of dealing with your taxes. And I know that when you initially think about investing, you don't want to think about taxes, but I promise you, bear with me for a second because it's going to be important and it's going to help because all of us are affected by taxes. And when you start deciding how you're going to invest, you really want to choose which approach you're going to take. There is tax deferred, which is the more traditional way of investing for retirement. There's also post-tax, which is newer and a bit more entrepreneurial, how to invest in a more entrepreneurial way to save money in a slightly different way than people have done for many, many, many decades, more decades than the entrepreneurial path. And then there's also a sort of post-tax strategy that you don't really save on taxes at all, but it really allows you to build wealth. And here are the accounts that are listed under each of those categories. When you think of a 401k, 403b, or a traditional IRA, those are all tax deferred accounts. When you see the word Roth, those are post-tax accounts. And I'll talk a little bit about that in a second. And then when you're trying to build wealth, you're really just going to use a brokerage account. So since none of us could just go straight up to the stock market and say, hey, can I get 5 shares of Tesla? We always need a broker, an in-between. And then once we choose the broker, we then choose the type of accounts that we use based on how we want to handle our taxes. Okay, so I'll explain a little bit of the advantages of using one over the other, but I just kind of wanted to give you an overview of how a traditional path means that you are paying taxes later on. The entrepreneurial path is paying taxes in the year that you make the money. And the wealth building account, which is the post-tax account, you are really just not necessarily having a benefit of taxes, but you're using that account to build wealth. So what exactly does it mean? What is a 401k or traditional IRA? Traditional IRA might be the one that many of you here will use, and I can answer some questions regarding that, how you get started, all of that. But essentially this guy here, Ted Benna, he was the one that came up with the idea of people investing for retirement and giving them an incentive. So he basically said, if you have a traditional career path where you're working and then in 40 years after you've started working, you're going to retire and then not make any money, it would be smart for you to take money out of your paycheck every month, put it into an account, save on taxes. So that means that you pay less taxes because this account was made for your retirement. And then when you retire in the future, after your account has grown to a 6-figure or maybe even $1 million status account, then you can pay taxes on that money. So have that money work for you, but in the meantime, you can save by having less tax responsibility. And so when he thought of this idea, people loved it. Corporations started to take advantage of it. And some of the people that really used this were like corporate America. A lot of the people that were working in offices for the first time, because prior to the whole working in office situation, now we're not working in the office anymore, as much at least. But prior to that, people worked at home or on farms, or, they were working out in the field. Then it became a thing to work in a building and work for a corporate company. And so that's when this came about. So all these corporate companies started taking on this idea. They liked Ted Benna's idea so that their employees can have this benefit of saving for their own retirement. So that was cool. And I'm going to kind of circle back to this. But a couple of decades later, this guy, William Roth, said, okay, Ted, I really like that idea. Cool. But there's just a catch to it. When you say at the end that we have to pay taxes when you retire, and I'm going to have this 6-figure or 7-figure account, what if I'm making more money? What if when I retire, I have real estate business and I have my own business and I own multiple properties and I'm like a gazillionaire? Why would I want to pay taxes when I am earning more money if I can pay taxes when I'm paying less money? And that was why the Roth accounts became a thing. And this is why the Roth IRA, Roth 401k, you're going to see that name. You could think of this guy right here on the right. He was the one that said, I'd rather pay taxes the year that I earn the money and never pay taxes ever again. So let's look at the tax brackets that exist right now. We're going to update this for 2022, but you can kind of just use this to get an idea. 10% tax rate when you make up to $9,950. Okay, so I'm going to focus on the single, but you can look at your specific situation if you would like. So the first $10,000, let's say you're paying 10% in taxes. Between $10,000 and $40,000, you're paying 12% of taxes on that, on those amounts. Okay. Then as you go up the ladder, 40,000 to 86,000, you're paying 22% taxes. 86,000 to 164,000, 24% taxes. 164 to 209. 32%, 209 to 523, 35%. And when you're making over $500,000, you are paying 30% in taxes on the first dollar after that amount. So it really works like a staircase. As you make the first 10,000, you pay 10%. When you make between 10 and 40, then you're paying 12% on that amount. So this ends up being an average and not a very specific number, because they're going to take a little bit from here, they're going to take a little bit from here in different amounts. So that's why on average, if you live in New York, you pay New York state taxes, and you make a general salary, let's say $50,000, you're going to end up paying somewhere between 22 and 24%. So the average is going to be around there. So when we think about taxes, it's important to know where you fall in the tax bracket so that you can have a tax strategy and choose the account that makes the most sense. All that being said, both accounts are wonderful. So you don't have to feel immense pressure to choose one or figure out which one is the best one, regardless of which one you choose, whether it's the pre-tax account that Ted Benna created, or if it's the post-tax account that William Roth created. They're both wonderful accounts, and they allow you to invest in the market so that you can build wealth and retain the value of that money that you contributed. Okay, so there are some additional perks to the Roth IRA. I'm not going to go over every single one of them because it's a lengthy list, but I definitely recommend this, especially the Roth account, especially for women. And my favorite reason is because when you have a Roth account and you have had it for 5 years, you are able to use money from that account for expenses related to childbirth and expenses related to adoption. And those are things that as women we do, and families of course adopt, both men and women. But I think that is probably my highlight and my reason why I tell every woman that I meet, open up a Roth account, even if you're just putting a couple dollars into it, because time will pass anyway, and you can always access that money for different reasons. You can also use it if you become sick or ill, if your expenses for that. You can even use it to pay taxes if you owe the IRS. So there's a lot of great perks. And again, if you text me, I can send you this full presentation, and you can also look it up online. So when we talk about how much we can invest per year, I always love to dream big and think of what's the maximum that I could do, right? Because we could, of course, say, listen, all I got is $50. And by the way, you guys, I started investing with $50 a month. I did not have a lot of money and I didn't know what I was doing. And I got started with $25 per paycheck because I didn't know what I was doing. And I thought, and I was making, I don't know, like $25,000 a year. So I was like, cool, let's do it. And my company gave me a match. So maybe you're in the situation where your company or your employer is giving you a match. If you contribute to it, they're also going to contribute to it. So the $50 that I was putting in, I was actually getting $100 because my company was matching. So it was already a great perk and a great reason to get started. So the limits on these accounts have gone up $1,000 for this one in particular, but the 401k, all of those that people, 401ks, 403bs, 457 and TSP accounts that are open through organizations and through companies, they have a huge limit of over $20,000. So this, it's actually $20,500 for this year for 2022, which equals to $1,625 per month and $400 per week. That's a lot of money. There are not a lot of people that can contribute this kind of money to an account, but that is the limit. And I want you all to think big and understand what the maximum is that you can use for these accounts and then work backwards from there. An IRA, which many of you here, I definitely recommend everybody in this room get an IRA. Because of those benefits, first of all, if it's a Roth IRA, and because it is wonderful to, even if you have an employer-sponsored account, to just manage your own account. It's great practice, and there's flexibility with it. So the limit for an IRA, regardless if it's traditional, like TED, BENA, or if it's a Roth account, the limit is $6,000, which is the same for 2022 and 2021 and 2022. That's about $500 per month and $125 per week. So this is a great goal that maybe not everyone can achieve $20,000 invested per year, but $6,000 can be much more reachable. And I remember a couple of years ago, that was my goal. I said, I just want to get to the point where I can afford to invest $500 per month. And it took time, definitely took patience. And eventually I got there, So getting to this point is a really great place where you're putting in $125 per week. And then the brokerage, which is that account that I mentioned that is for building wealth. There's no limit on how much you can put in per year. So it's really great. If you had a great year, if you won the lottery, if you won $1 million and you decide to put it all into a brokerage account after taxes, of course, that would be the best thing you could do because you will continue to just earn money off of that investment year after year. When do you open that final brokerage account? So think about those retirement accounts first. And then after you've exhausted those retirement accounts, after you've tried your best to get to those limits, or if you want to just strategically build wealth first before you start investing for retirement, although I think if you're thinking that, you're probably going to do both, and that's the best strategy as well. That's when you open up those brokerage accounts. There's also this sort of thing that people do that's called FIRE. It's Financial Independence Retire Early. And it essentially means that they invest a lot of their money. They live very frugally in some situations. They invest a lot of their money so that they can retire early, sometimes in their 40s. Maybe some people even retire in their 30s after they've worked at their job for like 10 or 15 years and invested like the majority of their paycheck. And that's, you can look it up, the FIRE movement, Financial Independence Retire Early. So when you're thinking about the order of accounts, you do your retirement accounts first. If you have one, if you have access through work, you do an IRA second, then you do a brokerage account, which is the wealth building account. And then you consider a crypto account because crypto is kind of the new thing. When we think about the stock market has been around for over 100 years, the way that it currently is now. When it comes to crypto, it's only been around about 12 years. So always make sure that you are going first to the places that are the most established, and then considering investing into things that are more newer and more speculative. Now that we talked about accounts, let's talk a little bit about, let's go a little further into how we invest once we decide how much money we put into the accounts. I listed my number here so that you can ask me many things, and also so you can get a copy of the presentation, 917-636-4049. Where to open accounts. Oh, and Alyssa, if you can drop that in the chat really quick, I would appreciate it, the phone number, so that I can send everyone the presentation afterwards. All right. Now, so where to open accounts, right? So now you have an idea of why you should be investing, and maybe you have an idea of how much you can invest. You know, let me start with $50, or maybe I could afford to do $100 per month, $200 per month. Now it's figuring out, so who do I give my money to? And I'm going to break it down for all of you, and I'm going to talk about all of these places where you can open up accounts, and I'm going to talk about them from oldest to youngest. So you can go to a really old establishment, or you can go to a really young establishment, but they're all giving you the access to the stock market that you need, but they offer slightly different services and slightly different mechanisms. So the oldest one that's still around, these are the three oldest ones that have been around, that have started many decades ago and are still around. Merrill Lynch, Edward Jones, Morgan Stanley. So these are full service brokers, and these are pretty much the brokers that kind of started it all, and they only were made or designed or worked with people that were rich. So for you to work with these people back in 1914 or 1922, 1924, they required that you paid them $2,000 to buy one share of one stock. So you had to be really well off, and that's $2,000 today's money. So imagine if you wanted to buy one share of Tesla, before you even bought the share of Tesla, you had to pay them $2,000. These are full service brokers, and they're the ones that treat you with white glove service, and they will have a financial advisor be at your on speed dial so that you can talk to them anytime, but it really does cost a lot. And although they don't charge $2,000 now to manage your money, they are still considered full service, and they have a lot of different options, especially for people that have a significant amount of money, have come on a significant amount of money, like a windfall, like lottery, but also truly they're just, because they're the oldest, they're the OGs in the business, they also tend to have a lot of customers, like past multi-generation type of customers. Then that was in the 1920s, right? Then in the 1940s, there was a broker by the name of Fidelity that came around, and they said, hey, you guys charge way too much money. $2,000 is way too much money. We're going to charge people, $50. And they're going to invest with us. And it worked. And a lot of people went to these discount brokers, Fidelity, Charles Schwab, TD Ameritrade, Vanguard, and E-Trade. And you can see there the years that they started. These are all great places to invest. I have personally used all of them. And I use all of them only because I am a teacher in this, and this is my life and what I do as a full-time job. You only need to choose one. You can choose Fidelity, you can choose Vanguard or E-Trade, and you'll be good to go. But these are all discount brokers. They make it really simple, and it's very inexpensive. What I love about discount brokers is that although they don't have white glove service, they do still have a great customer support team, and they can help you with a lot of your questions. They can't give you financial advice unless you pay for that service, but there is a great customer support team in all of these companies. Now, in the 2000s, online advisors became a thing. And what they established was that, hey, it's cool that all these old G's, these old brokers, these old OGs are able to invest for you and not charge you too much money. But what we want to do is we want to create an algorithm where you answer some questions and the machine invests for you. And that's what Betterment does, Acorns, Ellevest, and M1. And you can see the years that they started right along there. So that was really cool, very innovative, especially in the financial world. And then fast forward a couple of years later, apps started coming out. And the most popular one that has taken basically the world by storm has been Robinhood. So their mission was to really democratize the financial investment world. And they did that. They've acquired a lot of customers, especially during the pandemic. And really, since 2017, they have been on the uprise. But there are a lot of other apps like Robinhood. Some are SoFi, Cash App, Webull, Ally Invest. And basically, they don't provide a lot of customer support. That's something to remember about the lower tier and the newer ones, that they're not trying to give you a lot of support. They're just trying to give you access, which is great. But you really do want to have a better idea of what you're doing when you use some of these accounts. So which one is better is always the question after seeing these couple slides. And it really just depends on what your needs are and what your assets are. Like people that have a lot of mixed assets, like, oh, at my grandmother's house and I bought a house and, my grandfather passed down this Picasso painting to me. And when you have a lot of mixed assets, you really want to seek a financial planner, and you might want to have that white glove service because first of all, you have the means to do it. You have a lot of money in your account and you're going to have that customized support, which is really important when you have a lot of mixed assets. So the top tier is going to be great for someone like that. But for most people, literally 99% of the population, the medium tier is great. You have access, you have customer support, you have a great educational platform, which a lot of these mid-tier brokers have been establishing in the last couple of years, and it doesn't cost a lot to get started. And then the lower tier is really non-fussy, but you have to keep in mind, like I said, they don't offer support, so you want to be cautious of that. If you feel like you want more support, having an app might not be ideal for you. And you can also use different brokers for different needs. Like I use mid-tier brokers for my retirement needs, but I also have apps for my, what I call sort of my play account, where I can invest in things that I'm sort of interested in, that I'm taking more risk on, but it's not money that I truly am depending on and need. It's more of money that I have more flexibility with. And you can absolutely do that if you like. Having a mix of accounts is totally fine. So now you know where exactly you can go, that whole list of the different brokers that are out there that are the in between you and the stock market. So after you open up the account with them, you actually have to really, unless you're going to have them invest it for you, which is an option, you can do that, especially with that robo-advisor, like that algorithm. But you also can choose to invest on your own. And that is the way that you save the most money, because if someone is going to invest for you, they're going to charge you for it. And I will preface that right now by saying, please be cautious online. There are a lot of scams online. There are a lot of people that are just looking to make money and steal from people. Do not respond to people that you don't know online. Do not send anybody any money online, because with all the scams that are happening right now, people are just getting Facebook messages, Instagram messages, and they're saying, oh, I'll invest it for you. Don't trust that. Only trust these websites that are very, very secure, that you've heard here, that you can see isn't a real thing. Do not send your money to people. I have unfortunately seen so many people get scammed and out of thousands and thousands of dollars because they thought someone was going to do the work for them, and it was really just someone taking advantage of them, and they never saw that money ever again. So be careful with those kind of things. Only go to websites that are trusted. Make sure that it has the security tag on it, so it says HTTPS. That means it's a secured website. And of course, do your research before you start sending money or investing money or whatever the case. Whenever it has to do with money, just be super cautious. Think about things 3 times before you actually take action. So once you put your money into the account and you know how much you're going to put into it and you chose your broker, amazing. Now you start to decide what you're going to actually invest in. And a strategy that exists that is very, very simple is called index funds. And first, before we talk about index funds, let's talk about what an index is. I like to compare an index with a ruler. So the actual definition for index, it's a measure, a weighted average, a representation of a particular sector of the stock market. So it essentially is a ruler. On a ruler, you'll see all these little lines that represent a centimeter, an inch, whatnot. Every single line, if you think about it, can be a symbol for a stock in the market. So if you're looking at a 12-inch ruler, there are, let's say, 100 lines on a 12-inch ruler. That means that you can assign one of those lines to a stock. Tesla, Apple, Microsoft, Google, all the companies that are out there, right? You can assign them to that ruler, and that ruler is the index. That ruler is used by every single one of those brokers that we just talked about. So Fidelity, E-Trade, Vanguard, Charles Schwab, they'll use that 12-inch ruler and they'll mimic it and create a fund that you can buy, because you can't buy the ruler. The ruler is just a tool that's used by the stock market. So they make a bunch of rulers and it represents the top 100 companies, the top 500 companies, the top 3,000 companies, and some rulers actually represent the full stock market. So every single company that is available to you in the stock market is placed on a ruler. So as you can imagine, it's going to be a very long ruler. It's going to be one of those rulers that teachers use back in a yardstick, right? A yardstick ruler. So they create these indexes, these rulers, and then brokers borrow those rulers to create funds that look just like that. And so these are the most popular indexes that are out there, also known as indices. The S&P 500, so it's the top 500 companies in the US, the NASDAQ Composite, the Dow Jones, which is the 30 largest companies in the US, so much smaller group, and the Russell 3000, which is a much bigger group. It's the 3,000 biggest companies in the US. So a fund mirrors this ruler, and it basically can also be compared to a basket of stocks. Sometimes I call it a fruit basket. So instead of you choosing every one individual company, like, oh, I want to invest a little bit of this, a little bit of that, you can just pick up the basket. And you can have, instead of having to choose the perfect banana, the perfect apple, the perfect orange, you're going to choose the basket that has it all ready for you, and you can easily go check out. That's exactly what you do when you invest into an index fund in the stock market. So they usually trade once per day. What's great about them is that they have low expense ratios. They usually have a minimum to start, although that's kind of going away. And once you make the minimum contribution, there is no minimum to it. Here is one of the all-time favorites for index funds, and it's called VTSAX or VTSAX. It is the total stock market. So this is the biggest ruler that's out there. It's the full stock market. Every single company that's in the stock market, you can get it for the very low price of $99.26. The only thing with this particular fund is that it does have a minimum to start. You have to have 3,000 for it to start, but don't worry, because this is just one. And this is just one broker. Remember all those other brokers that I listed? So you're good to go if you don't have that $3,000 minimum. There's other options that are out there. But I wanted to show you this because it's an example of what you see when you start looking at funds. This is taken from yahoofinance.com. It's a screenshot that I grabbed, and it shows you how well it has done since it started. It started November 13th in 2000. And it was $30 a share, and now it's over $100 a share. So on the up and up, and this is why investing can be very simple, and it definitely, because of productivity and innovation, continues to grow. These are the companies that are inside that fund: Apple, Microsoft, Amazon, Google, or Google, also known as Alphabet, Facebook, now known as Meta, Tesla's in here, Visa's in here. So some really great companies. These are some Vanguard funds. I also listed some Fidelity funds, and note right here, no minimum. So for $12, for $14, you can buy the full stock market. For $12, you can buy the full international market. And for $12.19, you could buy the full US bond market. Zero expense ratio and no minimum. That's how you save money with investing, and you start with literally just $20. So if you have $20, you can buy this fund and you are an investor. Here's some that are created by Charles Schwab, slightly different prices here, and the international one has a $1,000 minimum. And this is just a little bit of allocation. We go a little bit deeper here, because essentially what I listed, if we look at the last slide, is the total US market, the total international market, and the bond offerings. So when if you let's say have $100 to invest, you might want to have a mix of these. And how do you decide what the mix looks like? You can decide something like this: 60% is for the total US market, 30% is for international market, and 10% is the bond market. And this is just an example. You could do 100% the total market, or 50-50 total total US market and 50% international market. You can start playing around with it as you go. What happens when you invest $500 a month for 10 years? You would have invested $60,000 and your account would become $87,000. What if you did that same amount for 30 years? $180,000 that you put in, that you worked for, blood, sweat, and tears, becomes $606,000. And that same amount invested over 40 years, which is obviously a lot of time, is only $240,000 invested to give you $1.2 million. And that is calculating just an average return of 7%. So it's really amazing what time does. And that's really the point of this final slide, is that time in the market is so powerful. The more that you could invest, the more it's going to grow, but not necessarily just amount. The longer you can invest is how much more your account can grow. So if you wanted to not spend 40 years investing, let's say you want to do it 20 years, but you put 100 a month, you're going to also get to these numbers. So it's something that you can definitely figure out and play with and really take advantage of. I'm going to pause here for a second to answer any stock market questions. Then I'm going to go maybe like 1 or 2 questions, and then I'm going to go over cryptocurrency, because it is a whole nother world. And it's a little bit of kind of like a bonus for tonight. So I'll stop sharing my screen now, and I'll go ahead and answer questions that y'all may have. Let me see if let's see, view, speaker view. I'm going to try to see if there's questions in here. So someone said, not sure about Robinhood. I use Vanguard. I started very slow, but now I'm more confident to put my money there. That's great. I've used Vanguard for sure. One of those mid-tier options. So they don't cost a lot of money to get started. A lot of their funds do have a minimum, but it's still a really great option. So I'm glad that you have been using it. Someone said, I started Robinhood, but someone told me that Robinhood is bad because the money I put in there will never be mine. What's that about? So the money is yours, first of all. So I'll debunk that. Don't worry. The money is definitely yours. Some things that we have to be really cautious about when we're listening to investment things or advice, and when we're reading about investing, is understanding exactly which market people are talking about. So what I believe you heard when somebody said the money is never yours has to do with the crypto market. And I'm going to go a little bit into that. So definitely hold on for that. But any money that you put into the stock market, into your account, it's your money. It's your money. What you want to do is you want to be very wise with what you invest in, because it's a functioning market, because it's alive, it can go up, it can go down. So if you are cautious and you're investing into things that have great fundamentals, if you're investing in something like the specific strategy that we talked about today, which is index funds, you really don't have a lot to worry about. But when you're taking bets on things that are very kind of speculative, and people are like, oh, invest into this new company that you maybe never have heard of, or maybe it's a company that you have heard of, but you put all your money into one stock, one company. That's a lot of risk that you're taking on. And so the market is always going to go up and down, but you have to go in with a really long-term strategy for it so that you can see the money grow. And also, you can choose to take the money out when you want, if you're using a brokerage account. If you're using a retirement account, you are restricted. You can't take it out before 59 and a half. So that's something that you have to keep in mind. So the money is yours. You can do whatever you want with it. When you are buying cryptocurrencies within these brokers, that's a different story. So when you buy cryptos, and I think I'm going to wait and really explain that when we talk about crypto. But in the stock market, when you use it to buy stocks, publicly held companies, yes, the money is yours, but understand that you're taking on risk when you're investing. Okay. Let me see if there's another question. And you can, if you have a question, you can also raise your hand. Oh, somebody mentioned Stash and Robinhood. Yes, those are both accounts brokers that you can use. If you really know exactly what you want to buy, they're great for that. If you need more assistance, you want to stay away from them, because you really want to use an account that can offer you a little bit more support where you can call in. With Robinhood and Stash, there's no number to call in. You have to send them an email and wait, I don't know how long, to get a response from them. So I would not recommend them at the top of the list, especially for new investors. Okay, so Oh, Alyssa said Roth IRA matches are very common in the domestic worker-employer relationships that have managed. Definitely something to look into, ask your employer for. Yes, absolutely, especially when you're negotiating like how much you're getting paid. Bring up the fact that, yes, you're working now for them, and that's amazing for both of you. You're getting money, they're getting an amazing service, but there's going to be a time where you're not going to work anymore. So you obviously want to ask, what do you offer retirement plans? What does that look like? That's an additional benefit that you can negotiate. And if they don't offer a retirement plan, that's your opportunity to say, well, if you don't offer a retirement plan, you're going to have to pay me more money, because that means I have to make my own retirement plan. All right. So it's a really great thing for you to do when you're going into negotiating for a job. Let's see. Not sure about, you guys are very slow. I think I've answered. Do you see any questions, Alyssa, that maybe I'm not seeing?
No, I haven't seen any.
Okay. Yeah, so if anyone has questions right now about a specific type of account that they want to open or their particular situation, feel free. I'm going to go into crypto in just maybe 2 minutes. Before I do, I want to talk a little bit about investing while you have debt. So debt is a reality for many people, especially if you have student loan debt. And the number one question related to debt and investing is, should I invest even though I have debt? And I think it's really important for you to first understand the type of debt that you have and how much you're paying for that debt. And then also understand that no matter how much debt you have, you need to invest for your retirement. Maybe you're not investing in a big way to become rich, but you really want to secure your safety for when you are older and no longer going to be working. So even if you do have student loan debt, if you look at the types of debts that are out there, student loan debt is low in terms of how much you pay in interest. Debt that's really high in terms of what you pay in interest is credit card debt. Then it's personal loans, and then it's car loans, and then it's student loans, and then it is a mortgage loan. So even if you owe on a house, even if you owe in student loans, even if maybe you have a car note, you still want to invest because those are very low interest loans that you're paying for, so what you can make in the stock market, it can be greater than what you pay in interest on those loans. When you have higher cost loans, like credit card debt, and when you have personal loans, those are some that you really want to attack, because the market doesn't generally return more than what you're paying in interest. So on a credit card, if you're paying 20%, 25% in interest, you're not going to make 20 to 25% in returns in the stock market. Typically, some years we do get lucky.
A quick question, because
sure,
you mentioned those cards like the Bloomingdale's, the Nordstroms, the Macy's, the Best Buy, all those cards. What if you have them? Because I have them, and I've had credit advisors tell me keep the balances low, but I literally do not use them. I only buy like a pair of socks or something, and they keep increasing your balance. But what's the point? Because it's more of a headache to even have to think about it. So how do you get rid of them without affecting your?
Yeah.
How do you get rid of them?
It's going to affect your credit score when you initially get rid of it. So if I were you, I would strategize and use the card for what you can. And if they're giving you a higher balance, and the higher your balance is, when you apply to a new credit card, they can see all that. So they're gonna be like, oh, Alyssa has a Macy's card and she has, $8,000 limit on it. Let's give her $8,000. Actually, let's give her $10,000. They see that, and that's their way of being competitive with their credit cards. So they're gonna offer you a limit either equal or higher to that Macy's card. And so that's your opportunity to open up a card with a bank that's not related or affiliated to any sort of store. Like you can do Chase or you can do American Express, and then you close that card. So you want to do it strategically. I always recommend for people to do things with their credit like at the beginning of the year or in the summer. Do it now in January or in the summer, or like every 6 months, right? You want to relook at all of your credit cards. If you can get rid of some that suck because the interest rate is high, because they're store cards and they don't even offer you a lot of great benefits, get rid of them and stick to ones that offer you great benefits. Cashback rewards, travel points, don't charge you fees on a yearly basis. Those are the type of cards that you really want to stick to. So use the store cards. A lot of times store cards will approve people. So oftentimes it'll be the first card we have. And that's fine. And you can use it to your benefit until you can basically graduate to a better card.
And what if you have all the cards?
If you have all the cards, I love it. If
you have like a Discover and a Visa, and you also have a Macy's, and it's again just a matter of like manage.
Yeah, if you have a lot of them, right now is a perfect time at the beginning of the year for you just to decide, in the next 6 months, I'm going to get rid of the ones that have the highest interest. So you can lay it out, make a list like Visa, Discovery, Macy's, look at their interest rate, and those are going to be the first ones that got to go. So you're eliminating them. You don't need them. They need you more than you need them. Eliminate the ones that have the highest interest, and really try to stick to no more than 5. Okay. It's not bad to have credit cards, but you want to have 5 powerful cards instead of 10, cards that have like a $2,000 limit or even $1,000 limit. You know what I mean? It's better to have 5 cards that have a $20,000 limit, which takes time. That's not something that comes overnight, than to have a bunch of cards with like small limits, and it just feels very restrictive. And on top of that, you're paying a lot of interest. So creating a debt pay down strategy, that's actually my last post. So if you go on Instagram, the last post that I shared was a couple of things that you could do right now to at least think about and create a plan for yourself. And one of the things on that list was to cut how many cards you have in the next, I put 90 days, but you can decide. It could be 90 days, 3 months, it could be 6 months, or you can just set it, okay, by the end of the year, I want to get rid of all of my store cards, and then go from there,
Thank you very much.
Yes. Was the investing, oh wait, I do see a question. Hold on. I think it's from Kinshasa.
Yes, yeah, to piggyback on Alyssa's question, so do you suggest taking out the two that you don't want right away, like take two of them out, or do you suggest taking one out, waiting a while, and then taking the second one out?
I would wait a little bit. That's why kind of thinking of that either 3 month or 6 month period is smart, because when you get rid of one, your score is going to take a little bit of a hit. So when you think about how you use your credit card, you actually don't want to think about how you're using your credit card. You're actually going to think about, when will I need good credit? So what does the year look like for me? Do I want to apply to a new card, and when am I going to do that? Or am I going to apply for a home loan? I want to make sure that my credit is looking good for that. And then you kind of want to work backwards. If you really want to eliminate two cards, think about potentially losing 25 points on your credit report, because you are decreasing how much. But it's okay. Listen, I know that, and I'm with you. I know it's hard to think about, but that's how it happens. But think about
yeah.
So Band-Aid.
Right. Well,
so you're ripping off the Band-Aid. Your score's gonna go down. But you're making the best choice because you are getting rid of the cards that you don't need. But again, before you get rid of stuff, before you make major changes, make sure that you know exactly, okay, when do I need to have good credit? Is there?
No. No, I just got my house. I was waiting until I got the house to get rid of them, because I heard if you get rid of them, it takes a hit. But I took a hit still with the house loan. I'm like, I didn't want my score to go down, but it did go down. So I'm like, I don't know if I wanted to go to my 20 points again right now.
Okay, so in your situation, just wait a tiny bit, because the great thing, congratulations on the house. Woohoo! That's amazing. That is amazing. Something that you should be so proud of. Though you do want to wait a tiny bit, unless you don't need to apply for anything else. If you don't foresee that you're going to apply to anything and there's no particular reason, like you had a reason to have good credit, right? So you can get the house.
Right.
But if you don't have any particular reason to have good credit in the next year, then rip the Band-Aid, take all the hits right now, and you'll be fine. By next week, you're going to be recovered. You're going to be recovered.
No, I like the 800 look more than the what is it now, 775. I'm not, like, every time I see that, I get mad. I'm like, I worked so hard for that 800. Give me back my points. I want it back.
Honestly, you have very high expectations, and you are very amazing. Okay. 7 anything is amazing. Okay. So you should definitely be proud of that. Remember, everyone, that these scores, there's a lot of math that goes into it, and we don't want to be stuck on what the score is. Something that you want to focus a lot on is, what is my net worth? And when you buy property, that's your net worth going up. When you save more, that's your net worth going up. When the stock market returns more, that's your net worth going up. So that's really the number that we want to focus on, more so than, what's my credit score? So, but again, I'm very proud of you for getting your home, and don't you worry, you got this. You can space them out so you don't freak out over the drop. And then by the end of the year, you can get rid of them. Okay.
Okay. And then one more question. I've heard before that you can ask a credit card company, like let's say you have with Capital One or Chase or whatever, you can ask them to lower your interest rate, but I'm not sure if that's still being done. Do you know?
Yes. So you can absolutely ask, when you are trying to better your score, 2 important things that you want to do, basically like every 3 months. I definitely did it every 3 months, sometimes every 6 months, so they don't get annoyed with you. But you can call and ask them to increase your credit line and reduce your your interest rate. I'm sorry. So increase your credit line. Okay, I want to go from 5,000 to 10,000. And right after they say yes or no, and you can decide if you want a hard pull or a soft pull. If they do a hard pull, you're going to lose about 10, 15 points on your credit report. So you also got to be ready for stuff like that. Or if you don't want a hard pull, you can say, I don't want a hard pull. And then they will just use information that they have, and they'll ask you, well, how much do you make? And, you know, what do you do? Stuff like that. And then they'll decide if they'll raise it or not. After you do that part of after you establish that in the conversation, the next thing you want to do is ask them, please reduce my interest rate. And this is the perfect time to have that conversation with your credit card, because we are in what's called a low interest rate period. Inflation is very high. Everything, all loans right now are very low. So loans on properties are very low. Everything is low right now because the market, because of the pandemic, essentially. As soon as the pandemic hit, we started going into a low interest period. So that's the perfect reason. So if you needed a script, you can literally say, hi, so, you know, the general interest rate right now is 4%. That's what the Department of Treasury says. But I'm being charged 20% interest. That's a big difference.
Right.
I've been with you for a long time. Can you please lower my interest rate? And they'll go on the computer and they say, okay, we can reduce it to 14.99. And you literally do that over and over and over and over, 3 months, every 6 months, until you get to the place where you have the best interest rate. And I'm talking about 8.99, you know, like the lowest that they could do. You know, they'd be like, damn. And I'd be like, you called like 20 times in the past 5 years. Like, okay, here, you get the lowest interest rate, you won. So that's kind of what you want to do. Just maintain that so that you're saving money every single month, and you're also increasing your credit line. So you're also improving your credit score.
Awesome. And then, okay, so one more quick question, piggybacking on that. Because I've noticed, like, I've reported the same income 2 years in a row. And you know, they ask you, so it's the same income, even with the same income. Did you hear me?
Yes, and I know it went in and out, but I know what your question is, because they do ask for what your income is. And yes, even though you have the same income, you can still get credit increases. So
Great,
don't let that be a reason, you know, why you don't ask. Like, you can still have the same income, but you've already been with them an additional 2 years. So that gives you more power as a valued customer to also get an increase.
Awesome. Thank you so much.
You're welcome. Okay, I see a question from Camila.
Hello, thank you for doing this, first of all. Hello. I have the opposite of Alyssa. I have one credit card. I don't have any credit card from any stores, because I think once I have them, I'll feel tempted to buy stuff that I don't need because I have them. So I don't play with danger. So, but is that bad to only have, because I used to have 2 bank accounts, and I don't want to manage anything. I have one bank account, one credit card, one savings account, period. I don't have a credit card from any store ever. And when I closed my bank account, my other bank account, my credit went low for 5 points, but then a few months later came back up. So it's fine. I have to have another bank account, or one is fine if I'm managing well and it's enough? Or it's
How
good
much
to have.
credit line do you have with that one card?
Huh?
How much credit do they give you, that one card?
I went up, now it's 770. 770.
770? Oh, the score is 770, but how much credit line do they offer you? Like, how much can you spend on that card?
Initially, they gave 500 and then 2,000 and now 8,000. But I don't use anything.
Great. And I love that. You should definitely keep it that way. So what I
mean, it's not that I don't use anything. This is what I can pay in full. Otherwise, I don't use it.
Yeah. So the highest level of credit line is $50,000. After you have $50,000, any credit card is gonna think you're like amazing. You're like, you know, you'll get approved for anything. So it's up to you if you want to have 2 or 3 cards total and have a total of $50,000 of credit line. Never use it, still do exactly what you're doing, but it's try to get to the place where you get to $50,000, because that's what, when we talk about dreams and when we talk about all these limits on these things, because remember, these are all just, there's math to this. There's like a strategy for it all. So you can absolutely try to get, or do what you're doing and get to $50,000 credit line. I would at least recommend that you have 2 cards. And the reason I say that is because you never know if a bank is going to go out of business or sell off, or something goes wrong and they close your account. Oftentimes, I don't know if anybody remembers Washington Mutual. Washington Mutual was a bank that was around in like the early 2000s. And they eventually went out of business and they got bought by Chase Bank. So everybody got moved from Washington Mutual to Chase. So when I didn't have a credit card at the time, but the people that did have credit cards at the time, they actually got their accounts closed and they had to reapply with Chase. So that's just a specific scenario that you want to kind of keep in mind. And not, if it's a huge bank, it's probably not going to happen. You know, Washington Mutual, it was big, but it wasn't huge. You know, JP Morgan Chase has been around since 1910, but it's not likely for it to happen. But I would at least feel more comfortable having 2 cards. Like if something were to go wrong and something were to happen, you at least have another card. You know, because if you only have 1 card and that's the only credit card that you have, and something happens with the card, or even you decide that you want to close the card, you're basically starting over, you know, and so your credit history is going to be starting from the year that you open up a new one. You know what I mean?
Because I had Bank of America and Chase, but Bank of America on my savings, and I was like, oh, let me start slow. And I was like putting a little money every month, and the interest rate is higher than the Chase. And I was like, why I have Chase if I'm getting nothing? I'm getting nothing from Bank of America anyway. So I closed Chase to get a little bit more on Bank of America. So it's there. It's not much, but it's all I have. So it's better to have both just in case.
And for everybody listening, I also want to make sure that we're talking about the same thing, because there are bank accounts where you keep your cash and you keep your savings, and then there's credit cards. So with bank accounts, you really only need 1 savings account, 1 credit debit account. Your money is never going to disappear. Like if you have up to $200,000, it's FDIC insured. So even if the bank goes under, the FDIC is going to come in, and the Federal Reserve is going to step in and give you all the money that was in that bank account, you know? So you don't have to worry about that with checking and savings account. But since we were talking a little bit about credit cards, that's what I was referring to, having 2. So when it comes to credit cards, you want to have 2 credit cards. You know, you don't want to just depend on 1 credit card. And even if it's 2 credit cards, 2 different banks, because I have 2 credit cards with the same bank, which isn't as safe. And like what the point that I'm trying to get across, which is you want to have a little bit of a mix. And so if you have Chase and if you have Bank of America and you have accounts with them, checking accounts and savings account, yes, they're not giving you interest rate there because interest rates are very low. You're not making money off of it. That's enough. You don't need any more checking or savings accounts, you know? If
my money
chose to.
So my money is saved with Bank of America. I don't need to have another one because nothing's going to happen. They disappear with my money. No. I can keep bothering them. No, I'm saying because I'm from a different country and this happened in another country with my mom. But that's in the 80s. So anyways, I can keep bothering Bank of America until I get to 15,000. Eventually they'll get it.
You're talking about your credit card, right?
1 credit card. I don't want to have another. 1 is enough.
Yeah. Yes, you can just continue to have that card and continue to ask for increases, and you can get to 50. I mean, typically banks, unless you're making over $150,000, they won't give you more than $30,000 on 1 card. Okay, so that's what I'm saying. You might need 2 or 3 cards to get to that $50,000. Like the most in my personal experience that I've seen banks give in one particular card is 30,000 if you're making under 150,000. If you're making over that, you're gonna get $50,000 limits, $100,000 limits. Yeah, but like for the regular person, like 30,000 is probably the most that you're gonna get on that 1 card. With Bank of America, you should definitely try to get to that place. And like I said, open up 1 more card strategically when your credit score looks good, you know, and you're ready for it. Try to open up 1 more card just so that you have a sort of backup just in case something does happen.
Okay, thank you.
You're on mute.
Reina, I think, has a question.
Hey, ladies and Guy. I had a quick question. So I have, long credit history, great credit history, but I have several accounts. Like at Chase, I have 4 credit cards. Is it possible to merge all of those balances into one card?
Yes, you can absolutely ask Chase to do that for you. Their biggest card is the Chase Sapphire card, or if you have a Chase Reserve card, those are their biggest cards. They're more high scale cards. So you can absolutely ask them to combine it into one card, and it'll be the one that's like the Sapphire card. If you have like the Chase Freedom card, they may not, but they could, absolutely. Like I just opened up the Chase Freedom card recently, and they gave me a $28,000 limit because, like I told you, when they look at your credit report, they pull your full report and they see all this information. They can see my other credit lines, and they saw that I have an American Express with a $30,000 limit and another a Citibank one with like a $30,000 limit. So they try to match that, and they did the best they could. They didn't get there, but they did the best they could. But yes, I would go ahead, call them up and say, I have these cards. I would do them one at a time. So like I would say, oh, I'm closing one card out of the 3 that I have, or if you have more than that, and can you move that credit line to this other card? And they will most likely approve it. And then like a couple months later, you can do another card and be like, hey, I want to close this card out. Can you transfer this credit line to this main card? So basically you want to decide the card that you want to keep with them.
Right. And I guess that would be the card with the longest history on it. So so you're saying they wouldn't do it all at once and like issue you a new balance? Okay.
Typically they would not.
Okay,
Yeah.
so you got to do it one at a time.
Yeah.
Okay.
Mm-hmm. But they'll definitely combine some for you. They just might not do it all. You know what I'm saying? And that's why I would say don't do it all in one shot. Do it little by little.
Thanks.
You're welcome. All right. So I think that I'll move on to the crypto part. And this is just a little bonus. I'm not going to go too deep into it, but I definitely want you all to just have a basic understanding of what crypto is. And even especially before I start this segment, know that scams are huge in crypto. Okay. So they're always like, oh, you want to invest into Bitcoin? Send me $500. And people actually do it. I know it sounds crazy, but people do it. So let's just talk a tiny bit about that, and then we'll wrap up for the night. If you come up with other questions, feel free to raise your hand or unmute yourself and let me know. Jump in. Okay. Alrighty, it's loading up. Alyssa, let me know when you see the presentation because it still says loading on my end.
I can see the screen.
Okay, great. All right. So let's talk a little bit about cryptocurrency. What exactly is it? So I like to talk a little bit about history, and the first time that cryptocurrency became known was in 2009 by someone who goes by, it's not even their real name, but they go by Satoshi Nakamoto. And this was the person that came up with Bitcoin. And cryptocurrency, in its true definition, is a digital or virtual currency that it's secured by cryptography. So what's really amazing about it is that this cryptography is really essentially like numbers, and it's on a blockchain technology that was also created and established. And what makes this so revolutionary is that it has nothing to do with the federal government. Every single currency that we have, that we currently use, the dollar, the yen, the peso, every single currency that's out there is controlled by the government that it belongs to, of the country that it belongs to. Cryptocurrency, and the founder and creator of Bitcoin wanted to revolutionize this whole concept of having to depend on the government to establish what our interest rates are, to allow us to use money in whichever way, shape, or form, to restrict us with taxes. And although cryptos are not escaping taxes, not at all, they definitely are going to fall. There's more laws that are being created to make sure that people pay taxes on crypto. The point of it was so that this system is not controlled by one particular government, and it's more a globally used currency. So if you are interested in crypto, the first thing that you want to do is think about wallet, a crypto wallet. So the same way that we have a wallet to keep our credit cards and our debit cards and receipts and things like that, it's important to get a crypto wallet, and it allows you to store your private keys and the information that's required for you to buy cryptocurrencies, whether it be Bitcoin or Ethereum. And it also allows you to establish a digital signature. So the wallets can be an actual device, or it could be a program or an app or a website. So there are different ways, and there's different types of wallets that you can use to use cryptos. And we're going to get into the different types. There's hot wallets and there are cold wallets. A hot wallet is basically something that lives in the cloud. So it could be a desktop website, it could be a mobile wallet through a mobile app, or it could be something that a place where it's being held kind of digitally and is not physical. A cold wallet is the exact opposite of that. And those are wallets where you actually, when you buy it, you plug it into the computer, you download the crypto, whether it be Bitcoin, Ethereum, Dogecoin, and it lives in what looks like a USB. And some examples of cold wallets are Trezor and Ledger. And then above, I have examples of hot wallets. So you don't need physical device. You can just use a very secure password and two-step verification so that you can get into your crypto wallet, a warm wallet. So Bitcoin right now is at about $46,000. We had a high of about $65,000. It is the most expensive or the highest valued crypto that is out there, but it's not the only one. There is Bitcoin, that's the biggest one with the largest market cap, so the most amount of people have bought into it. There's Ethereum, there's Tether, there's Binance Coin, Cardano, Dogecoin, which maybe you heard a lot of in the news, XRP, USD Coin, Polkadot has been one that has become very popular, and Uniswap. These are the top 10. There are many, many more. There are a couple thousand coins that are available right now. And every day, like, new ones come out, but none of them hold like the value and the weight of these top 10. And these are the top 10 because they have the largest market cap and they have the largest transactions going on. So before you start investing into Bitcoin, you want to definitely have a financial foundation, and that's cash, savings, a 401k or IRA, good strategies for those accounts. And you also want to truly have a wealth plan established, because with crypto, you're really talking about a long-term approach. Some people get into it and they get really lucky, but that's very far and few in between. And people oftentimes will lose money before they really make any money off of it. So although it's not something that has been around for a very long time, it's definitely something that has become powerful enough for us to acknowledge it and do more research about it and learn more about it and invest a small part of the money that we invest every month into it, but definitely not something that we can just blindly sort of trust, like anything that we invest in. So that's kind of the little recap on cryptocurrencies. I personally use Coinbase. I also use Gemini. And I also use SoFi. So someone mentioned earlier, you never own your crypto when you use Robinhood. And that is true. So, and the reason why people say that is because you don't physically own it for what it was designed to do. When you're using a broker like Robinhood, or even one that I use, which is SoFi, you're buying the ownership of it, but you're not literally owning it. And that's the difference between buying it on a platform that has been designed really for the stock market, and then buying it on a platform that has been truly designed to own cryptos, which are the warm wallets, those websites that I listed, and also owning a cold wallet like Trezor. So that's the difference. I think that was what you had heard. I forgot who it was that mentioned it, like you don't really own it. And that is the truth. But the fact is that you're still, you still have ownership of the value of it. So if you bought crypto, Bitcoin, let's say, for 40,000, and then in a couple years it's at 100,000, you still have access to that gain, and you can sell your ownership to take advantage of what you made in it. But you don't physically own the crypto for what the crypto is itself. So it's a little bit kind of complex in some ways, but that's kind of the gist of it. All right. Something else that I had wanted to quickly share is a couple of different ways that you can invest depending on age, and how you look at your portfolio depending how old you are. So the things that you want to really think about is, how much time do you have to invest? Are you investing for short term or long term? What is your family structure? And what are your current needs versus your future needs? So when you are starting out, when you're young, you have an ability to take on risk because you have time to recover. And you do want to have a long-term approach. You want to have a foundation of the total stock market, like we talked about, like that big ruler. But you also want to explore individual stocks, and that way you can kind of take a little bit more risk and potentially buy a stock that could do really well. But in that same breath, you can also buy a stock that tanks. But because you're young, you can recover from it, right? Because you'll be able to make more money. When you're in your mid-level, you take on medium risk. You still want to have a long-term approach for sure, but you also want to think long-term, short-term. And you want to have a mix of accounts, like the list that we went over: 401k, Roth IRA, brokerage, even crypto, because you have learned you have learned more about investing, and you have taken your time, and you also are in the space where you make perhaps more money than you have in the past, which gives you more flexibility to invest more. And also, when you're in the medium level of risk, you can explore focusing on investing based on mission investing. So taking care of the planet, things that are really important that don't have like a huge priority in terms of making money in the stock market, but are really great, especially to take care of our social needs and our environmental needs. Then when you have a family, you're thinking about the next generation. So your risk is way much more pulled back, right? I can take risks now, more risk than I will in the future when I have children, right? So you have investment accounts, but you also have life insurance, because if you have children that are underage, you want to have insurance that can cover them. Have 529s for them to go to school, or even a brokerage for them to start building wealth early on. You also want to protect your assets while building wealth. So you want to be cautious again with insurance and how you invest. Then if you are over 50 years old and you are investing, there is still so much potential. I do get a lot of students that tell me, I feel like I am too late. And trust me, you are not too late, because it really is important for us to look at the statistics. And the truth is that women live into their 80s. So 50 is still considered midlife, okay? So you have a long way to go. I was very blessed to have my grandmother live until she was 88. I want to say she was, and my grandfather lived till he was 94, I think it was. So it's important that we never hold ourselves back because we think it's too late. You want to take minimal risk on the amount of money that you will need within the 1 year. And then you can take risk on other things. You can also diversify your investments a smart thing to do when you are older is try to partner with people that can invest into assets that can provide cash flow. So with your children or nieces or nephew, buy a property that can pay you an extra $300 or $400 per month, right? So that creates cash revenue. And then investments that have a strong or immediate return on investment, understanding that you're taking more risk, but also having a portion of your money that is just like truly secure. And this is absolutely the time and opportunity for you to build family accounts and to invest for children and grandchildren. I have a little bit about ownership, which we won't have too much time to get into, but there are a lot of different things that you could do in terms of establishing ownership for yourself, creating businesses, and making, providing services, and then also having rights to things like royalties, intellectual property, websites and URLs. All of those things are things that you can establish and create and invest into that can give you a great return in the future. I have a little bit about entrepreneurship, and I'll summarize it in like the main bullet points. It's about creating and innovating, managing your finances, hiring a team, and considering funding, which is a whole topic that I go over. If anybody is interested in taking and being a part of my program, there's definitely opportunities and ways that you can join the program. You can visit investinglatina.com to find out more. A little bit about intellectual property and where you could do more research. And again, I can send this to you as long as you text me the word wealth to my number. Last thing is a quote from the co-founder of Airbnb. If we tried to think of a good idea, we wouldn't have been able to think of a good idea. You just have to find a solution for a problem in your own life. And that's truly what makes a successful business. All right, y'all.
Thank you so much, Julie. That was awesome.
Yeah. I'm so glad that you all came in tonight and learned a little bit about money management and about investing. There's always a lot that can be learned. There's always more that's happening. And especially as new asset classes are established, kind of like crypto and NFTs, there's always going to be newness. But of course, we can depend on foundational investment strategies like investing into the full market that people repeatedly, decade after decade, have proven that the market continues to go up. So if you invest in that very simple way, you won't have anything to worry about.
Awesome. Thank you so much, Julie. And thank you everybody for coming. This is great.
Thanks,
and follow Investing Latina on Instagram. She is constantly posting really informative posts every day. So
true. Yes.
Put it in the
You're
chat.
welcome, everyone.
The information was great. I enjoyed it.
Thank you, Dexter. That's awesome. Thank you for coming.
Thank you. I'm so happy. Thanks, everyone. Follow along on Instagram. If you think of a question, you can feel free to send it to me later on Instagram or DM. Just let me know. Like, hey, I was in class on Monday and I just thought of something else. I'm happy to help you. Alyssa, thank you so much for organizing this. You are amazing. You're a gem. And I appreciate what you do for the community. So thank you for hosting and for having me. I will see all of you online on social, and just beware. Remember, there are a lot of scammers out there. So no, never send anyone money at all. Like no one, unless it's your mama. Do not send anybody any money, okay? And even her, make sure you give it to her in cash or something, or like right in front of her. So be very cautious of that because it is something that affects the finance community online. Be cautious. Thank you, everyone. Have a great day. If you haven't started, get started with investing. If you have started, keep investing.
Thank you.
Thank you very much.
Good night, everybody.
Thank you. Bye.
Good night.
Good night.
Good night.